The banks typically don't want to see that you are borrowing money from somebody else as well as them for the same property. Welcome back to Confident Real Estate. I'm your host, JC. Today is time for another Q&A with some of your viewer questions. Today's question comes from Zach, who has a question about using investor funds to buy another investment property. So we have this email from Zach telling us that he has already purchased a duplex that he is house hacking. That means living in one unit while renting out the other unit for income and pretty much paying for the mortgage while getting some equity appreciation on an annual basis. Now he's looking to buy a second investment property that he will not be living in. He wants to get a typical residential loan for a multifamily residential home, a duplex, triplex, something similar in nature to what he currently has as his first property. However, he just bought this first property back in April, so his funds are slightly diminished. He says that saving up for another 20% down payment for another property is going to take him some time. He doesn't go into detail as to how long, but he thinks it's going to take him much longer than he is willing to wait. And I understand that. So he's wondering if he can bring in an investor to help him with the 20% down payment. And apparently he's already found out on his own what we were about to tell him, that mortgage lenders do not like when you are borrowing from somebody else to pay the down payment because you don't have the funds to pay it yourself. Now he says his debt to income ratio would technically still allow him to qualify for the mortgage. It's his lack of savings that the mortgage lenders do not like. And here's the reason why, Zach. The banks typically don't want to see that you are borrowing money from somebody else as well as them for the same property. Whether the other party's money is secured as collateral against the property or totally unsecured is the question. So the bank still wants to have their lien priority in the event that they need to foreclose on the property because you're in default and haven't paid the mortgage. If there is somebody else who is owed money in relation to the property by you as the borrower, then the bank's going to wonder, are we in the first lien position or are we subordinate and in a lower lien position than that first lender? So that is why the bank is telling you that you must have this person who is helping you put money down on the property as a co-borrower and co-guarantor on the mortgage, and probably they're going to want to see that other investor be a name on the deed as well. The question is really, how are you structuring this investment? If you're buying a commercial property, then typically you buy that property in the name of a corporate entity, usually an LLC. And then each of the investors become members of that LLC pursuant to an operating agreement, and you may become the managing member who controls the day-to-day operations and financial operations of this investment property. Again, all things that are hashed out in the terms of the operating agreement. Here, where you're buying a residential property, you're going to want to qualify for the lower rates and the lower down payment requirements that come with residential mortgage loans that are typically Fannie and Freddie government-backed loans, right? So the issue is the banks are going to want to see the investors who are putting the money down on the property, that equity portion, on the loan and on the deed as well. They got to have skin in the game other than just their money to satisfy the bank's requirements for everybody being in basically their debt and allowing them to be in the first lien position as the only lien holder of a mortgage against the property. So again, how are you structuring the deal? Is your co-investor somebody who is giving you a unsecured personal loan? Banks definitely don't want to see that because again, you need to pay them back first, not the other person who might be a family member or friend. The banks want to know they're going to get paid first. If that investor is going to be an equity partner, then there shouldn't really be an issue. They should be on the mortgage and they should be on the deed. Again, investments are a risk-reward scenario. So if they're willing to share in the reward, unfortunately, part of investing is you're going to have to share a little bit in the risk as well. If that's an issue for your investor, that would probably be an issue for you going forward with this second investment. That being said, you may have to wait a little. You may have to save up some more and get yourself into a better position in order to go forward. If the person that's going to be your investor or the multiple people who are going to be your investors are willing to go forward and put their names on the mortgage and on the deed and be guarantors on the loan with you, then you're going to set up a tenancy in common agreement, because you're probably going to buy the property as tenants in common, with each of you owning your respective share of the property based on how much money you're putting in and how much sweat equity work you're putting into the property as well. You'll enter into a tenancy in common agreement amongst yourselves. It'll really dictate the terms. It's very similar in nature to a operating agreement for a limited liability company or some other corporate agreement that you would enter into if it was an entity buying the property, as it would typically be in the commercial setting. So here the tenancy in common agreement can accomplish a lot of those written understandings for you and accomplish that goal amongst you and your co-investors. Now, maybe you didn't have it in your mind that you were going to have co-investors with you on the deed owning specific portions of the property, because you really had an idea that long-term this was your baby, your goal, and you were going to be the main investor and owner and operator of this property. So what do you do if you've now had to enter into this mortgage and deed with these other people that own specific percentage portions of the property as are shown on the recorded deed? You're not at a total loss just yet. There are options, but what are they? So again, if you want the property long-term, but not the equity partner, you're going to have to set up some sort of side agreement that you and your co-investor can agree upon, assuming that your co-investor is willing to go forward and be on the mortgage and be a borrower, a guarantor, and be on the deed for the property. If they go forward with that, then you want to set up a side agreement that says something to the effect of, I will buy you out or have the option to buy you out at certain intervals, maybe the first, third, fifth anniversary of the closing date, and it's some metric for value, maybe 3% per annum over the after repair value of the property once you've done your renovations, which I'm assuming you have, to build some equity value in this property. I'm assuming you're not buying a turnkey property, that you're buying something that needs some level of renovation so that you can rent it out and start to see an equity appreciation on day one. So that being said, maybe the metric is a 3% per annum increase year over year off the after appraised value as your base value, or maybe you do an appraisal at the time you're going to buy out your equity partner and you buy out their share pro rata based on how much of the property they own that you're buying out. Now, this has given you time to save up additional money. So you have some extra cash to put towards the buyout, plus in theory, the property will have increased in equity value. So when you go to do a mortgage refinance, you can cash out some money of the equity value in that property and use that towards paying off your equity partner to make sure that you are now the sole owner of the property. You will then have to, at the same time you close the loan, enter into a conveyance of the property, meaning the deed will be held in you and your investors' names as co-tenants, and now they will have to deed the property over to you in your own name individually at the same time as you close on your mortgage. It's done fairly often. It's not that complicated, so don't sweat it. But this is necessary in order to get the property in your name alone, and also to qualify for the new mortgage that you're using to cash the investment partner out. You cannot convey the property out of your joint names without refinancing the mortgage. That is a fraudulent conveyance, and it is covered in all mortgage documents. So I know a lot of investors like to do that. They buy property in their own name and then they convey it to an LLC or bring on partners and give them certain percentages of the property. That is technically a no-go. So do not do that. Make sure you dot your I's, cross your T's, refinance the property and simultaneously convey it by deed out of your joint names into your name individually. And then you'll own the property. You may not have the wonderful mortgage rates you currently have now, but you'll be able to buy the property now and hold on to it and build equity appreciation in it, and then theoretically buy out your partner down the road when you are on more stable financial footing and have the capability to do so. So Zach, those are your options. I hope that helped. I hope the rest of you learned something from all of this and got something out of it. Again, as always, you must seek local counsel advice. I know I'm a real estate attorney, but we do not have an attorney-client privilege. You need to go seek the advice of local counsel, and you should definitely speak with your accountant, CPA, whatever, at the same time to understand the tax consequences and structure the investment to best suit your purposes now and for down the road. I hope you all got something out of it. Again, we appreciate you watching and tuning in to Confident Real Estate. Don't forget to hit that like button and also hit subscribe while you're at it. And we will see you next time here on Confident Real Estate. Take care.